purpose, and also registered in accordance with the Companies Act over 2015. So that is the definition of a company. So what do you mean by association of persons? Association of persons, basically, this whereby, for example, we may agree to come together and basically we start doing business together. We start doing business together. So therefore, association of persons, this basically whereby we have a number of individuals, 2 or more persons will come together. They agree to register a company in order to undertake some business, which by the end of the day is legal, or basically a business which is what? Lawful. So that is basically the definition of a company. And basically in this case, we are saying that this particular association of persons, by the end of the day, it has to be registered in accordance with the Companies Act of 2015. Because if, for example, today we have agreed maybe to carry on a business, and that business will be conducted in form of a company. So by the end of the day, we must register that company in accordance with the Companies Act of 2015. And I hope you can also be able to recall what we said in our previous class. Previously, companies were registered in accordance with the Companies Act, Companies Act, Cap 486, but this particular act has been scrapped and basically replaced by the new Companies Act, that is Companies Act of 2015. You may come across some old notes which are basically talking of Companies Act Cap 486. So that act has already been repealed. Basically, it has been done away with and replaced by the new Companies Act of 2015. So today, if you to register a company, either a private company, a public company, you must register that company in a valuation gain or loss on financial asset at fair value through other comprehensive incomes. And then we get what? We get the total comprehensive incomes. We get the total comprehensive incomes. So basically, this is how we present a statement of profit or loss for publication purpose. Then from there, we have the other component of a public financial statement, and that is the statement of changes in equity, or basically the statement of changes in net assets. Now, this one we said is basically prepared by a company to explain the movement, to explain the changes in the various items of equity. Why did the various items of equity change? Like the ordinary share capital, like basically the various items of reserve. So therefore, this one is basically prepared to explain the movement or the changes in the various items of equity. And basically, we say equity comprises of the share capital, comprises of the reserves. And therefore, these are basically various components of reserve. That is components of equity: share capital, retained earnings, share premium, revaluation reserve, general reserve, and basically we have the last columns here. So how do we prepare this one? We always start with the particulars of the details column, and then we have columns equal to the various components of equity the company is having, and then the total column. So we start with the opening balances, and then here you're going to record the other items, or basically the various transactions which occurred during the current year and which affected these opening balances. Now, some of the items which we record here is the profit for after tax. That one we added to the retained earnings at the start. Then if there were some items of PP which were revalued, like maybe land, buildings, so any revaluation gain or loss, we take it to this column for the revaluation reserve. You may also be told that the directors have proposed to transfer a certain amount of money from the retained earnings to general reserves. So that amount you deducted here, you take it to the general reserves. You can also be told that the company paid some dividends. So usually these dividends which were paid, mostly these would be interim dividends. If you can remember the question we did yesterday, we came across interim dividends, because equally, if you can be able to recall what you did in CPA intermediate level, you are told that if there are some dividends which are proposed to be paid, proposed dividends, those dividends are not supposed to be accounted for until they are approved for payment by the shareholder. So what we only account for here are the dividends which were paid, not the ones which were proposed, but basically the dividends paid, the dividends which were paid, not the proposed. Then in case there was a right issue is basically whereby the company will issue additional shares to the existing shareholders at a discounted price, at a price below the current market price. That basically increases the share capital and the share premium This one should be in the share premium account here. Share premium account. And then a bonus issue. A bonus issue, we said it is an issue of shares free of charge to the existing shareholders. We say this bonus issue will be financed from the retained earnings or the share premium. So the company will basically, once you come across a question, there was a bonus issue, you'll be told, how was that bonus issue financed? Was it financed from the retained earnings? Was it financed from the share premium? So basically, that's how we prepare that. And then finally, we have the statement of financial position. I've said formerly this was known as the balance sheet. So this one is basically prepared to ascertain the financial position of the company at the end of the year. How do we present this one? So we start by recording assets, which basically we classify into two, non-current asset and current asset. So for the current asset, this comprises of PPE, property, plant, and equipment. And basically, this one include all tangible non-current assets. We record intangible assets. We record investment property. Then we record the current asset, including inventory, receivables, cash and cash equivalent. And basically, we get what? We get the total assets. After getting the total assets, we proceed and we record equity. And actually, all the items of equity which we record here are basically the items appearing in the statement of changes in equity. Appearing in the statement of changes in what? Equity. Get the total equity, and then we proceed, we record the liabilities. Liabilities, we classify them into two. The non-current liabilities, which comprises of things like the bank loan, the long-term borrowing, the deferred tax liability, the redeemable preference shares, the debentures, and then current liabilities comprises of the payables, the short-term borrowing, the current tax payable, including things like what? The bank overdraft. Including things like what? The bank overdraft. So basically, I think this is what you need to recall from whatever you did in financial reporting, that format of preparing those particular what? Public financial what? Statements. So, and I think with that now, I want us, we go straight to a question. We go straight to a question. We go straight to a question here. To a question, and basically I want us to do the question which was there last sitting. Last sitting. Yes, so this is the question here. And I think you already have this question with you. I've shared this document with you in the class WhatsApp group. Have you seen this, Aziz, in the class WhatsApp group? Sharon, is the question in the class WhatsApp group? Yes, it should be there. It should be there. Yes, okay. Okay, so basically I want us, we go through this particular question, we see what the candidates were required to do. Yes, so what are we told here? We are told Farasi Limited has prepared the following trial balance for the year which ended 31st of March 2025. So these are trial balance. So basically we have the revenue. We have the cost of sales, selling and distribution, admin expenses, and then the structuring cost. I don't think this item was supposed to be here because you can see there is no figure associated with that. And basically, I've also counter-checked, and I've seen that there is no figure which is missing, because if we get these totals again, you'll be able to see our trial balance is basically balancing. Our trial balance is balancing. I hope you can see our trial balance is balancing. So what we will do, we will basically do away with this. We'll do away with this because no figure associated with that. Okay. So we have investment income. We have the interest paid on non-stock, land and buildings. Okay. We have land and buildings. We have plant and equipment. We have accumulated depreciation on 31st of March 2024. These are accumulated depreciation at the end of the previous year. And during the current year, there will be opening balances. So we have investment property. Remember, yesterday I was able to explain what are investment property. Basically, investment property is said comprises of two assets. One, land acquired by the company for it to appreciate in value and the company sell it in future. And number two, investment property also comprises of buildings which are leased out. They are generating some rental income. So those are investment property. But basically, in this case, I say if the company owned any other building, a building which is used, for example, as a factory, a building which is used as a go down, a building which is used as administration block, does that qualify to be an investment property? Automatically, no. That qualifies to be part of the property, plant, and equipment. So, but for any building to qualify to be part of the investment property, it must be generating some rental income. Some rental what? Income. That's basically what you need to just remember here. Okay, so we have then inventory at the end of the year, receivables, expected credit losses. Now, expected credit losses, basically, what do we mean by this? Expected credit losses. Now, expected credit losses, this previously what was known as the allowance for doubtful debts. Currently, we don't use that word. We use something called the expected credit losses. Why do we refer to this as an expected credit loss? If, for example, today you have a business and you have sold some goods to your customers on credit, so basically we say that you have given your customer some credit. You have given your customer some what? Credit. So if you expect that some of your customers or some of that money which is supposed to be paid by your customers will not be paid, that is an expected credit loss. You are expecting to incur some credit loss. You are expecting to incur some loss because you have extended a credit to your customer. So therefore, this previously what we were referring to as the allowance for doubtful debts, or basically the allowance, yes, the allowance or the provision for doubtful debts. Currently, we don't use that word. We don't use the word what? Allowance for doubtful debts. In fact, also the bad debts which are written off, we don't use that word currently. The bad debts which are written off, we use the word what? Credit losses. Credit losses, these are the bad debts which are written off. It is important for you to note that in this paper for BDA, you will come across this word in so many questions. Credit losses, these are bad debts written off, which are part of the expenses. Expected credit losses, these are allowance for doubtful debts. And I hope you can be able to recall how we account for allowance for doubtful debts. You basically compare the allowance for doubtful debts at the start, or basically that's what you used to do in financial accounting, in financial reporting. You compare the allowance for doubtful debts at the start and also at the end. Basically, you determine whether you have an increase or a decrease. An increase, basically, that one you use to recognize that as an expense. But a decrease in allowance for doubtful debt, you are recognizing that as part of the other incomes in the income what? Statement. We are going to do the same, this one. Yes, so we have that expected credit loss. We have cash and bank balance. We have the ordinary share capital share premium revaluation surplus, retained earnings. We have the dividends which were paid, 8% loan stock, deferred tax, trade payables, and then suspense. Then from there, we have some additional information about 1, 2, all the way to note number 6. What are we required to do? We are required to prepare for publication statement of profit or loss and other comprehensive income. Part B, we are required to prepare the statement of changes in equity. And finally, we are required to prepare the statement of financial position. So this was a very, very simple question. Basically, I've said that this is a question which was examined last sitting, the sitting for August of 2023. So remember what you said is that once you come across such a question, are you supposed to do your solution in a new Excel worksheet? No. Basically, what we said, just split your Excel worksheet into two. You have a question on this side, you have the solution on the other side, like that. So what we will do, we will go to the other side. That's basically where we are going to have our solution here. So we need to have the solution here. But basically, before we do that, there is something we need to do. We need to go through the additional information. Basically, we see, are there some workings which are required? Are there some items we need to compute? Yes, so we said you can bold this one. To bold, we said you control B, that is to bold. Then you can also underline it. You control U to underline, and then you can also shade it, basically to be more clear. The person who is marking your paper should be able to see that. That is your solution there. Okay, so but before we prepare what is required, I want us to go through the additional information we see. Are there some workings we need to do? So in additional information about your told, the following depreciation rates applies. So we are given the assets, buildings, and basically you're told the value for buildings is 30/30. The rate of depreciation is 5% straight line. Remember, at the straight line, we compute depreciation based on costs. Then plant and equipment, 25% reducing balance method. Under the reducing balance method, we compute depreciation based on the asset net book value, based on the asset net book value. So I think we can basically compute that depreciation here. So the depreciation on buildings will be equal to this one. We said whenever you want to compute something within a cell, always start with the equal sign. I hope you can see what I'm starting with. Start with the equal sign, and the depreciation on buildings will be equal to 5%. We just pick this one, don't type it, times the cost. I hope you can see this, the cost of buildings, because in the trial balance, what you're given here, we are given land and buildings combined. Land and buildings combined. So the cost of land, we are told is 30/30, is 30/30 here. So the cost of land is automatically the difference, 50/30 minus 30/30, which will give us what? 2,000. So therefore, the depreciation on buildings will be equal to 25% of the cost of the building. Remember here, we are only depreciating buildings, not land. So we take that, 5% of 30, and we enter. So that will give us what? That will give us 151.5. Depreciation on buildings, and I hope you can see that this one will be included as part of administrative expenses. We need to do the same for the other assets, plant and equipment, 25%. This will be equal to 25%. And because depreciation here is based on the net book value, so we need to multiply that. Okay, not on the net book value. Depreciation is to be computed using the reducing balance method. And the reducing balance method, we compute the depreciation based on what? Based on the asset net book value. The asset net book value. How do we get this net book value of the plant and equipment? So we get those particular values here. So you can see plant and equipment is this one. So this is basically the cost. So what we will do, we will take the cost. You will take the cost there. And I think what we need to do here, we need to have the opening bracket before that, because I need to compute the net book value. Alternatively, let me make this more simpler. Let's first of all, we compute the net book value. The net book value. Remember, the net book value here we say is also known as the carrying amount. What would be the carrying amount of this plant and equipment? It would be equal to the cost, this one, minus the accumulated depreciation, this one. And that will give us 205. So to compute the depreciation, we're going to compute it based on that net book value. So we will take the rate here, this one, times this net book value here, which is 205. And we enter. So that will give us what? That will give us a 51.25. 51.25. That is basically the depreciation on plant and equipment. And I hope you can see here, we are told that that one will basically be classified as part of the cost of sales. So we are done with that. And then you're told here in the last paragraph of note 1, meanwhile, land was revalued to shillings 2,400. So basically, once an asset has been revalued, we need to determine the revaluation gain or loss. The revaluation gain or loss. Basically, to determine that, we compare the cost and the revalued amount. The revalued amount is 24. Can you be able to get the cost? Can you be able to get the cost? Who can tell us how much will be the cost of the cost of land? remember this is the total value for land and buildings. And I hope you can remember in note 1, we are given the cost of buildings. The cost of buildings is 30. So what will be the cost of land? Who can be able to recall how we determine that? Or who can tell us how much will be the cost for land? The cost for land, let me see your answer. I see whether we are together. I'm told by Aziz it will be 2,000. Is that the position? What would be the cost of the buildings? Mary, Ruth, Sharon, T. What will be the cost of? What will be the cost? What will be the cost for land? Yes, in this case, the cost for land here basically will be what? Will be 2,000. Will be 2,000. Yes. So the cost for land will be what? 2,000. How do we get that 2,000? We will take this one, cost for land and buildings, and then we less the cost for land. I hope you for buildings that is 30. So that will give us 2,000. So therefore, this land had a value of 2,000 million. It was revalued to 2,400 million. So basically, it was revalued upward. So if it was revalued upward, which basically means that we have revaluation, we have revaluation gain. Revaluation gain. So the revaluation gain basically will be equal to this 24, this one, 24 minus the cost, minus its cost. The cost of that land was 2,000. So it was revalued upward with what? With 4,000. Then I hope you can also be able to recall, how do we recognize this one in our statement of profit and loss? How do we recognize this one? How do we recognize this 4,400 in our statement of profit or loss? In our statement of profit or loss, we recognize it as part of what? Other comprehensive what? Incomes. Other comprehensive income. So therefore, this one will be part of this one will be part of OCI. Other comprehensive incomes there. Okay. So we are done with that. And then you are told in note number 2, income tax for the year is 78 million. So this is basically the current tax. And then you are told, and the deferred tax expense besides that arising from revaluation above is 20 million. So we are given the deferred tax expense 20 million, but you're told this does not include the deferred tax on this revaluation. I hope you can be able to recall in a file and also AFR in case the company revalue an asset and basically there is a revaluation gain. This gives rise to something called the taxable temporary difference. Taxable temporary difference. So what we do, we compute something called the deferred tax expense. The deferred tax expense on that revaluation gain. On that revaluation what? Revaluation gain. On that revaluation gain. On that revaluation gain. And how do we compute this deferred tax expense on the revaluation gain? So we take the revaluation gain, which is this one, and basically we multiply that with the tax rate. Are we given the tax rate somewhere here? So in case the tax rate is not given, we use the rate of 30%. I don't think it is given. So we are going to use the rate of 30%. So we multiply that with 30%, 0.3 or just 30% like that. You can use 0.3 or 30% like that. So it basically means that this one is basically an amount of how much? Is an amount of 120 million. Now, who can tell us, how do we account for this amount here? How are we going to account for this deferred tax expense on revaluation gain? How do we account for this? Who can be able to recall this? Something you did in FR and also AFR. FR and also AFR, specifically that topic of deferred taxes. Yes, how do we account for this? How do we account for this one? How do we account for this? Yes, let me see whether you can be able to remember. So now this one, this amount of 120, number one, this one is basically debited in the account which is called the revaluation reserve account. So this one we don't take it to the income statement, but rather this one is supposed to be debited in the account called the revaluation reserve account. A revaluation reserve, this amount in other terms will be deducted from this 400. In fact, when recording this particular revaluation gain in the income statement or in the statement of profit or loss, we record it net of the deferred tax. We will take this, we less the deferred tax. That's why we are saying we debit this account. Because remember, revaluation reserve, these accounts should be always be credited. So by debiting 120, we need to reduce this. So this one, we are going to less that 120, and then we credit which account? We credit an account called the deferred tax account, the deferred tax account. So basically, to credit the deferred tax, we are going to increase the deferred tax at the start. I hope you can see this deferred tax. So this deferred tax basically will increase with this amount here, which is basically 20, and also this one. So the deferred tax by the end of the day will be 40, plus the deferred tax expense for the current year 20. So 40 plus 20 plus this. Plus what? Plus this. So that basically how we account for that deferred tax expense on revaluation what? On revaluation gain. So we are done with that. So in case of any question, feel free to ask. In case of any question, feel free to ask. Yes, and I hope you're together up to that point. Are we together up to that point, Ruth, Mary, Aziz, Josephine, Karibu? Are we together up to that point? Are we together up to that point? Are we together up to that point? Okay. So let's then move to the other point. So in the other point, number 3, we are told the interest on loan stock is paid semi-annually on 1st of April and also 1st of October. 1st of April and 1st of October. Remember when this year ended? This year ended on 1st of 31st of March 2025. So what we need to do basically is we compute how much interest was supposed to be paid in relation to those loan stock. And where do we have those loan stock? We have the loan stock here. So it basically means that this loan stock issued by a company were 8%, having a value of 18.25. So we need to confirm, or basically to compute how much interest is supposed to be paid for a whole year. It will be 8% times the value for the loan stock, this one. So it means that in a whole year, the company is supposed to pay 146. This is basically the amount to be recognized as an expense. But if you check in our trial balance here, you'll be able to see we are given interest on loan stock which had been paid, this one. And I hope you can see what the company had paid. The company had just paid 64. Had just paid what? Is it 64? Yes, 64 of that amount. And I hope they had been issued at the start. Yes, because there is nowhere we are given the date of the issue. So basically, it means out of this interest which was supposed to be paid, the company had just paid how much? The company had just paid this amount here. This amount of 64. It basically means that the difference between these two values, this one, and what the company had paid, this one. So this one was accrued. This one was accrued. So, and being an accrued, this one being an accrued, automatically this one would be accounted for as a current liability. This one would be accounted for as a current liability because it was not yet paid. And then number 2, when preparing our statement of profit or loss, how much amount are we going to capture there? The amount which will be taken to the statement of profit or loss is the interest for the whole year, the interest for the current year. This is the amount you're going to recognize in the statement of a profit or loss. Statement of profit or loss, not actually what was paid, but basically this is the interest which the company was supposed to pay during the current year. During the current what? During the current year. Okay, so we are done with that. And remember that interest or non-stock, that would be part of that would be finance cost. So we are done with that. So then number 4, we are told investment property had a fair value of 122 million at the end of the year. Remember, investment property, this asset should be accounted for in accordance with International Accounting Standard number 40. And actually that standard IS 40 requires investment property should be revalued to their fair value at the end of each year. Should be revalued to their fair value at the end of each year. Any increase in the fair value is supposed to be recognized as part of the other incomes, not as part of the other comprehensive incomes, but as part of the other income. So what do we need to do? We need to compare this fair value at the end of the year, which is basically 122, with the fair value which we have in the trial balance. And the fair value for the investment property in the trial. Okay, because this one is what is 122 million, 122 million, 122 million, and basically the other one is what? The other one is this. And remember, this is also in millions. Remember, this one is also in millions. In millions. Huh? What is happening with these figures? Are they supposed to be like that? Let me type it here. 24 million. 24 million. And then 122. 122. I don't know whether the figure has a problem, but I think that figure must be having a problem. That figure must be having what? Must be having a problem. But basically what we will do, we will have to work with that figure the way it is. But automatically, this figure was supposed to be more than this. Was supposed to be more than this. Because in most of the questions, what will happen is that you'll be given the fair value at the end of the year being higher than the fair value in the trial balance, such that that increase, you account for it as part of the other incomes. You account for it as part of the other good incomes, as part of the other incomes. This figure which is in note number 4, that figure must be wrong. Must be wrong. Must be wrong. I don't know which figure we are going to work with. Maybe let me quickly counter check from the original question here, because this basically question was borrowed from another paper. I see which was this figure. Let me quickly do that. Quickly do that. Yes, I can see this particular figure here. This one was supposed to be, because this is a question borrowed from a file, this was supposed to be 2440. We are going to change that to 2440. Sasa, yes. So you take note of that. Take note of that we have changed that particular value there. We have changed that value. So that was supposed to be 2440. Remember, I've said this is a question basically borrowed from a file. So this one will be 2440. This one will be 2440 like that. 2440 like that. So it basically means that now, if you compare these two values, the fair value at the start, which is 24, the fair value at the end, then you can see we have an increase. How much is the increase in the fair value? The increase in the fair value is basically an amount of, okay, this one, we can't get a correct figure, but basically the increase here should be 40 what? Should be 40 million. Should be 40 what? Million. Now, how do we account for this particular 40 million? How do we account for this 40 million? So this particular 40 million, remember, is known as a revaluation gain on investment property. Revaluation gain on investment property is basically part of the other incomes. In fact, this one, we are going to add it to the, this one will be added to the gross profit. This one will be added to the gross what? to the gross profit, simply because it is part of the other what? It is part of the other incomes. It is part of the other what? Incomes. Part of the other incomes. Part of the other incomes. Part of the other incomes there. Okay. So then number 5, we are told the suspense account related to the issue of 2 million new ordinary shares for cash of shillings 120. And then you are told one share has a par value of 100. So basically, we are told that the suspense in the trial balance, this one, relate to shares which were issued. How many shares had been issued by our company here? The company had issued 2 million shares at a price of 120. So how much amount was received from the issue of those shares? So we take the shares which were issued, 2 million, we multiply that with the 120 shillings, the issue price. So basically that will give us 240 million. So that 240 is the amount now which is credited in the suspense. So once the company issued shares, and I think we came across a similar transaction in the other question we did yesterday, we said the company should debit bank and then credit ordinary share capital and the share premium. So instead of the company crediting the share capital and the share premium, the company credited which account? The suspense. So therefore, we need to make the correct entry. So out of this amount here, how much amount are we going to credit in the ordinary share capital? The amount to be credited in the ordinary share capital, we said, is always based on the par value here. I hope you can see the par value. The par value is what? Is 100. So we will take the shares which were issued 2 million times 100. That will give us, that is 2 million times 100. That will give us 2 million. 2 million. This 2 million will be added to the ordinary share capital. The amount which is basically above, not 2,200,000. The difference between this, that is the share premium. So that one will be credited in which account? This one will be credited in the share premium. In other terms, when preparing the statement of changes in equity, this one will be added to the share premium. Will be added to the share premium there. And I think in our case, basically we are done with that. So let's move to the other note number 6. And basically, you're told that the company had not adjusted a credit loss of 15 million. What is a credit loss? Remember, there is something I've explained. Nowadays, we don't use the word bad debt written off. This is a key term you'll come across in so many questions for BDA. The term credit loss. Credit loss, these are bad debts written off. The company had not adjusted this, had not accounted for this. So anytime the company writes off some bad debts, how do we account for that? So these bad debts which are written off of 15 million and which had not been adjusted by the company, number one, we less the trade receivables. We less the trade receivables. We are going to less the trade receivables, an amount of 15. And then this 15 is an expense. So, and specifically, we recognize this as part of distribution costs. We recognize that as part of the distribution what? As part of the distribution cost. This amount had not been accounted for by the company. It is a distribution expense. And number two, we less it from the receivables. Then you're told the expected credit loss. Now I've said expected credit loss. This now what we use to refer to as the allowance or the provision for doubtful debts. So the expected credit loss on the remaining trade receivables is determined from the following probability of default. So we are told this is selling and distribution. So we are given the expected credit losses. So these are those particular amount which are expected not to be paid, but now we are given the probability of default. For example, an amount of 260, the probability of default is 5%. So what does that mean? It basically means that out of this amount of 260,000 or 260, and I think this one is wrong because I hope you can see all our figures are denoted in millions. This one equally should be denoted in millions. This one should also be denoted in what? In millions, not in thousands. Not in thousands. This one should be denoted in millions. So we are told the company expects that out of this amount of 260, the probability that it will not be paid, or basically out of this 260, 5% of it will not be paid. That's what you mean by probability of default. 5% of this will not be paid, 20% of this will not be paid, and 40% of this will not be paid. Now, what do we do in such a case? What we do, we need to create a provision for doubtful debt. And the provision for doubtful debt, I'm saying, that is now what is currently known as the expected credit loss. And basically, we need to compute that. So we will take 5% of this, because 5% of this is the one which is expected that it will not be paid. We create a provision for that equivalent to 5%. So we take 5% of this, we enter. So we do the same to this. We do the same to this. But basically, we say once we have developed a formula within Excel, then you just need to apply that formula. So like we already have the formula, and I hope you can see our formula up here. So to arrive at this value, we have taken this times this. So what we need to do is basically we bring our cursor here and we apply that formula to those two other rows. Basically, by default, Excel will be able to compute for us these values. For example, if you check what is this, you just click that cell and then you come up there. So that value is arrived at as 20% of this. What about this one? This one is basically 40% of this. So therefore, the expected credit loss, the expected amount not to be paid by the debtors is how much? 68. So this is basically the expected credit loss at the end of the year. Now, what we need to do, we compare this with the expected credit loss, which are given in the trial balance. So remember, I said that this is just equivalent to allowance for doubtful debt. We used to compare the allowance for doubtful debt at the start and at the end. So we already have the allowance for doubtful debt here. Where do we have it here? Where do we have it? We have it here. So basically, we're going to compare the two values. This is basically at the start, 58, and this one is at the end. We determine, do we have an increase or basically a decrease? And as you can see, in our case, we have what? We have increase in expected credit losses. In expected credit what? Credit losses. Expected credit losses. So how much is the increase here? How much is the increase? The increase will be equal to 68, which is basically at the expected credit loss at the end, minus the expected credit loss at the start. And that one increased with an amount of how much? Increased with an amount of 10. Who can be able to remind us? How do we account for this one? How do we account for this one? How do we account for this? In the income statement, how do we account for it? Yes, who can be able to recall? Yes, we account for this basically as an expense, specifically as part of selling and distribution. As part of selling and distribution. I think in our case, we are done with the workings. So what we need to do is basically we go straight to preparing what is required. We will start with part A. We said whatever you can be able to copy, avoid a lot of typing. So we highlight all that. We say Control C to copy. And basically we have it here now. We have it here, Control V, Control V, Control V, Control V. This is basically the statement of profit or loss for the year which ended 31st of March 2025. So we can equally shade that like that. And then also we need to have a single column, and our figures here will be in million of shillings. We need to indicate up there that our figures are in million of shillings. How do we prepare this one? We basically start with what? We start with the revenue. So we pick the revenue here. We basically copy. We paste that here. We paste that here. I don't know whether we reduce the font a little bit here. Yes, I hope you can be able to see my font. Is it too small or it is okay? Is it okay? Can you see what I'm presenting from your side, Josephine? Okay, sawa. Okay, so basically revenue is that particular amount. So is there any adjustment? No. So to this, then what do? We less the cost of sales. We less the cost of sales. Cost of sales, This one is already computed for us here, but I think we need to be having some adjustment. Do we have any adjustment which we need to make to the cost of sales? Yes. I hope you can see like we have depreciation here. So we need to make the adjustment here. So the cost of sales will be equal to whatever we have here, but I need to start with the opening bracket because by the end of the day, I'll have to multiply that figure with the -1 to change it to a negative. So we take this, and then to this, I need to add this depreciation here. Anything else to be included within the cost of sales? As per the workings which you have done here, nothing else. So I'll close the bracket, and basically I then multiply that with -1, basically to make it a negative, because our cost of sales here should be a negative. Should be what? A negative. And then, okay, sorry for that. I needed to introduce a comma, not to get the total. I needed to introduce a comma here. Because we said anytime, for example, your figures appear negative, you can see this figure is negative. In accounting, a negative figure should not be recorded like this, but it should automatically be inside the bracket. What do? Introduce a comma here. This one, like that. Yes. So you can see now that our figure is inside the bracket. Then we need to get the gross profit. We just do the auto sum here. So this now will be our gross profit. This will be our gross profit. And basically, we can equally bold this one. Bold, we say Control B. We equally underline this. We say Control U. And basically, we say that as we move forward, you need to note those shortcuts somewhere. How to bold, how to copy, how to paste, how to underline. Those are the obvious shortcuts you should be able to remember. So to this, then we have said we do what? We add other incomes. We add other income. So which other incomes do we add here? I think in our case, we have a number of other incomes. I need to bold this one. So from this trial balance, when checking for the incomes, you check items appearing on the credit side, the last column of the trial balance. So this is the revenue we have already captured. That we have this investment income. I'll just pick this one. I copy, I paste it here. Then I'll bring the figure here for the investment income. How much is it? 120. Any adjustment? No. So that is basically we have dealt with that. We have equally dealt with these two items here. We say that once you have dealt with an item, it's always important you shade it to make your work easier. So these are accumulated depreciation. Those are not incomes. Expected credit losses is not an income. All these are items of equity. Loan stock, deferred tax. Basically, we don't have any other component of income here or any other income here in the trial balance. But I can remember in the additional information, we had an item to be recognized as part of the other incomes, and that is this revaluation gain on investment property. Revaluation gain on investment property as per IFRS 40, as per IS 40, not IFRS 40, International Accounting Standard number 40, that one is supposed to be recognized as part of other incomes. The revaluation gain on what? On investment property. On investment what? Property. But remember, in this case, you have said any revaluation gain on PP is part of the other comprehensive income. And I hope you can remember this value is 40, this one, this 40. 40, yes, we put it there. 40. Yes. Do we have any other income? No. So I think what we need to do is basically proceed with the expenses. I think expenses, we can first of all pick those two. We copy, we paste them here. So selling and distribution will be equal to what we have here, this one. Is this having some adjustment? Yes. So therefore, what I need to do basically is to start with the opening bracket. This one will be equal to this. Then the number of items I need to add here from the workings. This depreciation is part of admin. Then we have working note 2, 3, 4, 5. Yes, so we have this note number 6. In this note number 6, we have this amount of credit losses, which are not being accounted for, 15, we add it there. And then we also add, and basically I say that whenever you're doing those workings, do I need to go back to the statement of profit or loss? I see what is happening there. No, all the workings you're doing appear here. So that's why you don't have to go back to the income statement. You see what is happening. So anything you're typing is appearing up here. Sasa? Yes. So we have taken the amount given in the trial balance plus this plus now the increase in expected losses, this one. And then what we need to do is basically cross the bracket. And because this is an expense, it has to be a negative. We multiply that with a -1. Okay. We multiply that with -1. I think I've already entered. Yes, but basically this is what you have done. Yes. So you have taken this amount plus the credit losses written off plus the increase, and then I've multiplied that with -1 to make it a negative. What about the distribution? Sorry, not the distribution, that the admin. I will do the same. I'll take this, and then there is a depreciation to be included here. That depreciation in note number 1, this one. We added anything else to be added there? I think no. Then I need to cross the bracket. I basically multiply that with the -1 to make it a negative, and that will be the final figure for administrative expenses. So then finally, remember we have dealt with those two expenses. Maybe you can shade them. So then from there, we take this interest on loan stock. The interest on loan stock, this basically, we refer to this as finance cost. And I think I've seen Aziz asking about semi-annually, because there is that information which you're given here. That information basically is just to confuse you. Aziz, what you just need to know is that as far as these loan stock are concerned, you just need to compute the interest for that year. The reason why you're told it's paid semi-annually, it means that when the year is coming to an end, part of the interest on the loan stock are not being paid. So you are not even concerned with that, although I think you have already computed that. So, but what you need to compute is the interest for the current year. And the interest for the current year, I've said, you take 8% of this value, which has given us what? 146. And then out of this, the company had only paid 64. The difference, which is 82, we have said is a current liability. So what we recognize here is the expense for the current year, this one. Do we have any adjustment for that? No. I just need to convert that to a negative by multiplying that with a -1 like that. Sasa? Yes. So basically we have dealt with this one, which is an expense. Which is an expense. Okay. Do we have any other expense? Remember also, when checking for the expenses, we check the items appearing here, appearing in the debit column of the trial balance. So all these are basically assets. These are assets, cash, asset. This dividend is not an expense. Yes, and I think in our case, basically we are done. So what we need to do now is basically we get profit before tax. We get profit before tax. So the profit before tax, we will take this one. We do auto sum here. Yes, basically this plus this minus those expenses, and basically we are getting that figure we had right hand, and equally we do what? We bold Control B there. So to this then we proceed and we do what? We less the income tax expense. So for the income tax expense, this comprises of two components of tax, the current tax. So the current tax and the deferred tax. But in our question here, we have a deferred tax expense. If you can recall the question we did yesterday, we had the deferred tax what? Income. So the deferred tax expense, where do we have that? We have it in note number what? This one, note number 2 is 78. That is the current tax. 78. Maybe you can just type it as a negative directly. Negative 78, like that. What about the deferred tax? The deferred tax basically is 20, this one. The deferred tax beside the revaluation, the deferred tax on the revaluation gain. So this deferred tax on the revaluation gain, we have said that this one is not taken to the income statement. Rather, it is deducted from this revaluation gain. So we have 20, this one, negative 20 like that. So we enter. So then we proceed and we get what? We get the profit. The profit after what? The profit after tax. So the profit after tax, basically we do the auto sum here. Yes, and then we do what? We bold this one. And then we equally underline this, Control U to underline. Yes. So after this, we proceed and we add now the other comprehensive incomes. The other comprehensive incomes, OCI. And equally, for example, anytime you want to do some changes, you have typed something is wrong, don't type it within Excel here. So highlight that item you want to edit, and it will appear up here. You do all your editing here. Sasa? Yes. So because if you try to do the editing here, you can do it here, but it will give you a lot of work. Do all your editing up there. So the other comprehensive incomes, basically, these include, we only have one, and that is the revaluation gain on what? On land. Revaluation gain on land. And basically that revaluation gain, I hope you can be able to recall, it was 400, this one, but basically we have to less this deferred tax. So we are going to record it here net of that deferred tax. So we will take 400 minus the deferred tax expense, which is basically 120. So that will give us an amount of how much? 280. So and I think in our case, we are basically done. We need just to add those two values there. And we get what? We get the total comprehensive incomes. The total comprehensive incomes. Total comprehensive incomes. Total comprehensive what? Income. So basically, we are done with what is required here in part A of that question. We are basically done with what was required here. So this was a very, very good question. Although I think the only tricky part was in relation to these expected credit losses. I think that was the only tricky part. But I think for the other items, this one was quite simple. And for example, in this question, you may ask, how was it marked? How is such a question marked? So the marks allocated to that part were basically 8 marks. And for each correct entry, you get 1 mark. For every correct entry which you are recording here, you get 1 word, you get 1 mark. You can see there are some free marks here. For example, for this tax, this current tax, this deferred tax, those are free marks. Also, if you were able to compute this revaluation gain, but you also less the deferred tax, is 1 mark. Maybe, and all these items here. Investment income, revenue, you can see that one does not have any adjustment. Revenue, yes. So basically the marks allocated there were 8. For every correct entry here, you get 1 mark. You get 1 mark. So let's move and basically do the other part because of time. We finish on time. So we copy this and then we paste it here. Yes, so basically what we see is that whenever you're doing this particular question in an examination setup, avoid a lot of typing. Avoid a lot of typing because that's now what will be consuming your time. Whatever you can be able to copy. Whatever you can be able to, or what you can't be able to copy, and that is maybe what you need to type. Yes, avoid a lot of typing there. Yes, so how do we prepare this? We prepare this, remember, to show why there was a change in the various items of equity. So here we always start with the details column, and then basically we're going to have the various items of equity. So we have the items of equity here, starting with ordinary share capital, share premium, revaluation, retained. So what we will do, we will copy all this. We will copy all this. Basically, we say Control C. And then you can see those items appears now in what? In loss. But once I bring them here, I want those items, each item to appear on its own column. What will I do? I'll basically let start the first item starts from there. What I'll do, I will right click, and then I will be able to use this particular function here to transpose. To transpose is basically interchanging items appearing in rows now to appear in column. Understand? Yes, you can also use the same function to interchange items appearing in columns to appear in what? In rows. Yes. And then we say that you can come here and you do what? You wrap this to basically appear in the words to stop hiding. We wrap, we equally wrap, but you can do the for all instead of doing for individual item like that. Yes, for this one, maybe you can do away with the date here. The date is not important. The date is not important. Equally here, you can center this. You can center this. You can also bold it like that. Maybe for this revaluation reserve, you can make it a little bit bigger like that. Yes, and then finally, what we need to do is we add the total column there, the total column there, the total column there, like that, like that. Yes. Now, what we start with here, basically the opening balances, we start with the balance brought down. The balance brought down, the balance brought down. The balance brought down basically the balances we have in the trial balance. All these balances here, these ones. We will pick all these balances. We copy all of them, copy. And then we paste them here. What you're going to do, you're going to transpose like that. Yes, and then we get the total there. Yes, so then we need to take into account the transactions which occurred during the current year and basically which affected these items of equity. Maybe we can start with the profit after tax from a statement of profit or loss. So a profit after tax, this will go to the which column? The retained earnings column, this one. So where do we have profit after tax? Whatever you have computed up there. What else do we have? I think during the current year, we have this revaluation gain. I'll just copy that one. I bring it down here. And this revaluation gain will go to which column? This one. And also we record it here net of deferred tax, this one. We record it as 280. What else do we have? I think we have in the trial balance, we have some dividends which were paid. Where do we have those dividends? We have these dividends. We copy this, we bring them here. Remember, you have said that dividends should be paid from basically what? The profits. So we take that to the column for retained earnings, this one. And that is an amount of how much? Dividend paid. Dividend paid is basically 100, but that one we must record it as a negative. I'll have to multiply that with a -1 to make it a negative like that. Yes. What else do we have? Yes, I think we have dealt with all these items here now. All those items, we have dealt with them. What else do we have? I can remember we had in the additional information, we have this transaction for the issue of shares. Where do we have it? We have it here, shares which were issued. There was issue